Welcome to Midstate Money Talk. My name is Cynthia DeFazio, joined today by Kevin Dietrich and Joe Dietrich of First Choice Financial Services Incorporated. To our viewers at home, we have a very important subject for you today. The subject today is to contribute or not to contribute. That is the question. What is the problem with qualified plans? There's some confusing information on the news. I mean, I know the news is never confusing, but today's show, we're going to talk about what people are thinking when it comes to their qualified plans. Kevin, how are you today?
I'm great. How are you?
Fantastic. Thank you so much for asking. And Joe, how are you?
Wonderful, wonderful. And yourself?
I am doing fantastic. Thank you. Always a pleasure to be with you. I'm so excited about today. So I want to get into this show, actually. This is very interesting. So there was an article that came out recently, and I want to read this so I don't miss anything. It's from Investment News titled, "Stop Contributing to Your IRAs and Your 401ks." This article went on to say, stop contributing to your IRAs and your 401ks completely. This has to be a typographical error because, after all, traditional retirement plans, they were all 401ks. We were told to always contribute to them. So what are we going to peel back today to discover what can be the problem, actually, with some of these qualified plans? It went on to say that this strategy no longer works, and that people need to reduce their IRA balances, not increase them. They're recommending that we reduce them. This is very interesting to me. So I have a question. Kevin, let me ask you this. Can you explain why someone might suggest that you should stop building your IRAs, your 401ks, and other qualified plans and deferring the tax bill?
Yeah, that's an interesting concept, as you mentioned. Well, let's define a qualified plan, first of all.
Okay.
The viewer at home might not even really realize what a qualified plan is. So when the IRS looks at your funds that you're investing, they really look at it several ways. One is qualified. Is it qualified to meet the tax deferment? And so what are tax deferred accounts? So when you hear the term qualified money, it's really tax deferred money. So like 401k, IRAs, 403bs, TSAs, TSPs, those types of things are all considered tax deferred or qualified money.
Okay.
So they have a tax benefit because you're growing, you put money into it, you get that tax benefit, that reduction of your taxes, and then it builds. And then when you pull the money out, withdraw the money, that amount is taxable at that time, at whatever tax rate you're at. So it's a very interesting concept that someone say, that's not, to not stop contributing to it. It might be a good principle, but I think it's short-sighted to just generalize that and say you should stop altogether. I think I know where they're getting at, and we're going to get through that through the show. But just an overall, simplified saying you just stop doing it. That's short-sighted, and I don't think that's good advice.
No, it is kind of scary when you think about it. And for me, what you just said, I'm thinking qualified means you're qualified to pay taxes on that, right?
Later on.
Right, exactly.
But actually, it meets the qualification for tax deferment. That's what it stands for.
Okay.
Yep.
Wow. So, Joe, honestly, when we were working so hard, and I know many of us still are, and we've been told and we've been taught that contributing to your 401k is a good thing. But all of a sudden, it looks like it's not such a good thing. That's a little bit infuriating. What can you share about that?
Yeah. So a little clickbait, maybe. This is a big, bold statement. Is it something maybe we want to adhere to strictly? No, but it does get us thinking about some serious things. And that is, where does this all come from? Well, the Revenue Act of 1978 kind of crafted in the origins of the 401k, right? Well, let's think about what was going on in 1978. The highest marginal tax rate was 70%. So deferring the taxes may have been a really good idea. And continued, a lot of people have built their retirement savings in these types of accounts, and that's great. But it gets us thinking about how is that relevant today? And just blindly continuing to do what we've always done, we're going to get what we always got. And so maybe now's the time to take a look and be strategic as to how we start crafting our retirement plan. So now we're in a lower tax bracket, and our national debt is $1.8 trillion. So we're kind of some factors here where perhaps taxes are going to go back up. So it's all about timing, it's all about planning, and we want to be very intentional as to how we put that together.
Okay.
However, a lot of people are making more money than they ever made in their life.
True.
Yeah. So, and they're coming in to us and saying, how can I eliminate my tax burden now? Not just in retirement, but now. Well, then I'd say, well, how much are you contributing to your IRA, to your 401k? About 3%. Well, if they contribute more, there's a tax reduction of their total income.
Okay.
So going back to the original article, it is really it's something that we need to take a look at in your particular situation.
Yes.
It's individual based on your information. A lot of the folks we interview are putting in 10, 15%, 20% of their income into their 401k.
Yeah.
And it's because they want to try to reduce that tax burden now. But being short-sighted in that particular area is that they're going to have a huge tax bill later.
Yes.
There's
Got to be a balance there.
Yeah,
and
there's
so
some
it's very,
competing
very
concerns.
important to sit down
Yes.
with someone that understands that and get a sweet spot on what should I contribute now and should I contribute to a Roth. We're going to touch on that a little later
Yes,
too.
most
So
definitely.
those are balances that we need to, and it's hard to pinpoint that and to navigate that a lot of times on your own because you just don't know what that sweet spot is.
That's true. And Kevin, I'm so glad that you mentioned, because it's not a cookie cutter answer when we're talking about a subject as sensitive as contributing to your 401k and the article that said stop doing it. You need to take a look at everyone's personal situation, what works best for them. Joe, this next question, this is for people that are out there right now and they're saying, wait a minute, this doesn't affect me because when I retire, my income and my taxes are going to go down.
Yeah.
What do you say to people that are thinking about that right now?
Yeah, absolutely. And this is why it's important to sit down with somebody who does this day in and day out, that is well versed in this, because there's a lot of competing priorities here. We think, should I contribute more? Should I contribute less? Am I paying taxes now, paying taxes later? There's a lot of confusing items there. So yeah, there's this myth, or there's this, again, generalization that when I retire, my taxes are going to go down. It's plain and simple, right? I'm not going to have an income anymore. Well, is your lifestyle going to change all that much? Maybe, maybe not. What are you making now versus what you're going to need to draw on later in your retirement? So for many people, that's a myth, that their income is actually going to stay pretty stable or maybe even go up. And it's age 73, you're going to hit RMD stage and you're going to be forced to take more money out and pay more taxes. So depending upon how you've structured your plan or lack of structuring your plan, you could end up paying more taxes in retirement.
It's
And
really
I think-
dangerous to make generalizations.
Yes.
I mean, are you married, Cynthia?
I am.
And I am too. And I was always told, you never say the word never or always, right? Because those are general terms and it encompasses a lot. So
That's true.
We shouldn't do that in our approach to finance either. And we should, we should never contribute to IRA, or we should always contribute to a 401k. So there's got to be that balance. So we shouldn't generalize any of this. We need to get help because it have that balance in our approach to that.
Well, with true professionals that really specialize in the retirement years, which is exactly what your firm does, you're passionate about that, making sure that people have the right answers for any situation that they're facing. You truly do.
Yep.
To our viewers at home, there's a number to call on your screen. That number is 888-959-2743. What we're talking about today is the confusing landscape of tax implications that can come your way from doing the right thing. You've been working hard your entire life and you've been saving into your 401k. You've been building a nest egg, if you will. Well, all of a sudden you realize that could be taxed at a level that's far higher than what you had planned. Is there a solution for that? Well, the rest of today's show, we're going to be talking about some solutions that you may want to take advantage of if you have been working hard and doing the right thing by contributing to your retirement plan. Call into the number, 888-959-2743. You're being offered a customized retirement plan, a plan that's going to suit your needs and your goals. This is not a cookie cutter approach. This is one-on-one time that these gentlemen will give you to listen to you, to really understand what your needs are and your dreams are for retirement. If you don't have a pen or you're running out the door, grab your smartphone, click on the QR code at the bottom corner of your screen. That'll take you right to the landing page for First Choice Financial Services Incorporated. You can schedule your time accordingly. We're talking all about some solutions coming up now for some increased tax rates that could be on the horizon. We'll be right back momentarily.
First Choice Financial Services, we're based out of Camp Hill, Pennsylvania. So if you're familiar with Harrisburg, there's a river that splits the mid-state in half. And on the right side is the Harrisburg City, and on the left side is what we call the West Shore. We're based in Camp Hill, Pennsylvania, which is just across the river from Harrisburg.
Everybody that works in our firm just has a heart for other people. My 2 sons are partners in the corporation. Their wives are very active in the corporation. The rest of the people in the corporation are, all but 2, are family.
I wouldn't want a practice that's not family-based or faith-based. If you're a believer, you're a Christian, then you have to live that. It's your life. It's who you are. It's your identity. My identity is in Christ and Christ alone, and I'm not going to waver from that. And why not have that spill over into my business, my practice? It's all over our walls, all over our TV screens, and they can see our heart, and they know, hey, we take care of them, and we love them as individuals, and we care for them and their soul.
When we've sat down with somebody and we've taken time to get to know them and put something into place that's going to really meet their needs, to see the look of relief or the posture change when they walk out of the office feeling confident and a little less worried of the years to come.
Welcome back to Mid-State Money Talk. My name is Cynthia DeFazio, joined today by Kevin Dietrich and Joe Dietrich of First Choice Financial Services Incorporated. And we're talking all about those of you in the audience that have actually worked your entire life getting through retirement years and you've been doing the right thing. You've amassed a lot of fortune, if you will, into your 401k, into your IRA, into your SEP. What happens when you get hit with a huge tax bill? Can you avoid that by taking action today? We're going to talk about some solutions, and I love today's show. Kevin, let's be the lighthouse on that angry ocean of taxes, shall we?
Sure.
What are some solutions that people can look forward to help right now?
Yes, some solutions is to get with someone that knows the rules, knows the law, and understands you have to have that balance as far as what you're contributing to IRA, what you're contributing to maybe a Roth. And so there are some, the Secure Act 2.0 last year developed some strategies that or opened up some guidelines that were able to contribute to a Roth and even sometimes get that matching contribution if your employer allows that to the Roth. But Roth contribution is a huge importance as well because that grows tax-free. There is no tax advantage to that when you actually contribute from a tax deferment standpoint. But also, if you can do some Roth conversions as well, taking existing IRA funds or 401k funds and converting them to Roth is a great strategy as well. And we'll touch on that a little bit later here as well. But I just wanted to highlight some of the key advantages we can have with the Roth money.
So there is hope. There's always hope. I love that. Joe, what about people that are in the audience today and they're asking themselves, what about the strategy and the tax deductions for my IRA and my 401k contributions? Won't those be lost if I do something like this?
Sure. They may be lost. And you may be thinking, well, I like that tax deduction now. And, that's maybe a little bit of a short-sighted view. And certainly none of us want to pay more taxes than we need to. But we like to, when we sit down, not just think about today's taxes, but long-term taxes. And we need to think about where are we at in history with the rate that we have in taxes. The tax law is going to sunset in 2025, the end of this year. And it may continue in a similar fashion. It may change drastically. We talked about that debt that's hanging over us on a federal level. So that is going to need to be dealt with at some point. So, if you're sitting in a 24% tax bracket now, you very well may have a similar income need, but be paying more taxes later. So that money's going to come out. You want to pay the taxes at 24, 22, or some other percentages, or the higher percentage. We need to think about that. When we think about, Kevin talked about the Roth. We can contribute to the Roth. We can contribute to our IRAs. We can have savings that are outside of those accounts as well, that are what we call non-qualified, or a taxable account that you be investing in, but you may be responsible for taxes or capital gains on a year basis. But these 3 different types of tax qualified accounts are going to give us some flexibility and durability down the road. So maybe some maybe challenging decisions to make, but if you look at it as an overall whole, it could be to your benefit.
Sure, it sounds like real long-term value,
There's obviously
Kevin.
benefits to the Roth, whether you contribute to the Roth or convert IRA funds to a Roth. One of the benefits is just the RMD rule. So at age 73, if you're born after 1960, it's up to 75 is the RMD age now. from that Secure Act 2.0. And so at age 73, for example, you have to start taking money out of your IRA or 401k, so the qualified accounts we talked about earlier.
Okay.
And so if the Roth is not part of that, so if you're putting money into a Roth from a 401k standpoint, or just outside the 401k, or you're converting existing IRA funds or 401k funds to a Roth, that doesn't qualify for the RMD rule.
Okay.
So that it grows tax-free. When they pull the money out, it's tax-free, and it doesn't, hurt you for the RMD age.
Yeah, you're not going to be forced to pull out your Roth money because of RMD. Now you can if you'd like to. That's where that flexibility comes in.
Yeah.
The new roof, new vacation, some emergencies. Roth money has significant advantages, not just from a tax standpoint.
Right.
Sure. And Kevin, I know you're passionate about having people do the Roth conversion. Can I ask you, is there a client that you helped recently that benefited from doing a Roth conversion?
There's clients that we help every day that benefit. One particular client, let's just call his name Jim. He came in and we were converting money every year for the last 5 years from existing IRA fund that he had into a Roth fund, and so it's growing tax free. And so he needed to buy a new truck.
Okay.
And so it was sort of a unexpected purchase because he went to get inspected. There was some rust that they found, so he had to get a new truck. It wouldn't pass inspection.
Oh, wow. Okay.
So there's he was happy that he had to buy a new truck, but he wasn't happy that he had to buy a new truck.
I get it. I know that feeling.
He came in, he's like, where did I get the money from? He was like flabbergasted. I said, hold on, remember that Roth? He said, yeah, I know we've been putting money in, but I've been paying tax on that every year. I said, yeah, here's the reason why. So now let's pull like 20 grand out of the Roth, 5,000 out of the IRA. You pay tax on the 5,000, no tax on the Roth.
And it fit inside his existing plan, didn't disrupt his tax record for that year. Yeah. So that's the kind of flexibility we're talking about.
I love that. But Joe, isn't it always time sensitive as well? Can you talk about how you have to stay within certain parameters of time when doing the Roth conversion?
Yeah, there's no magic account. So with the Roth, there is some provisions as well. So there's a 59.5 rule, obviously, just like a normal IRA. If you're going to take money out before 59.5, you're going to pay a 10% penalty on that gains. Now, when money goes into a Roth, when you contribute to a Roth, that's always your money. You can take that out. But it's the growth that we're talking about that we get those tax advantages, that tax-free growth. You got to be 59.5 to take it out. But there's also some 5-year rules that we need to be determining. And whether that's a contribution or a conversion, they're slightly different. But overall, most people just need to know that there's a 5-year rule that you're going to need to adhere to as well.
Okay. And how important is it to do tax planning like when taxes are low? Let's talk a little bit about that because, wow, it can be a benefit if someone wants to do this right now versus the unknown rate in the future.
Absolutely. So consider you've got an IRA that you say $500,000, right? And you want to start converting some of that, paying it at a rate. And we adhere to, we want to be strategic. So we're not just saying take $500,000 and convert it. But say you convert all of that at, 32%, so that's now. Well, we don't know what that's going to be like in the future. Now, if you don't convert that $500,000 may have grown by the time you want to take it out, RMD age, to $1 million. And now you're paying 32% on $1 million. So do you want to pay the taxes now, strategically, at a low tax rate, or pay taxes on a larger sum of money later at an unknown rate? So while it is a challenge and maybe a little bit uncomfortable to sit down and really think about paying more taxes now, in the long run, it could be an extreme benefit.
Absolutely.
Or you can do it systematically like we did with Jim. We did over a 5-year period. We pulled out, we converted, let's say $10,000 a year over a 5-year period. So now he's at $50,000 in this Roth. He was able to use $20,000 to buy a new truck.
Wow.
And so we can do it as a lump sum systematically. And that might change every year as far as how much we can convert over from IRA to a Roth each year based on their tax bracket that year and their other income.
Yeah, to Kevin's point, we want to be strategic about it. I was using an example of a big lump sum, and that's rarely the answer. But if you're strategic about it, you can be paying taxes at a lower rate than what I was talking about.
Yeah, that sounds like planning.
I love planning.
Yeah.
Planning is a good thing.
That's right.
We should give opportunity to the folks at home to do more planning.
Absolutely.
To the viewers at home, if you're listening to our show and watching our show and you're thinking, wow, I've never heard about Roth conversion strategies like this. I don't have a plan for my possible tax obligations, if you will, in the future. If you're confused about that and you'd like to have some clarity, you're being offered a customized retirement plan today just by calling in 888-959-2743, 888-959-2743. It makes sense to plan accordingly today when you know what the current tax rates are versus the unknown in the future. If you want more information about the Roth conversion, this is the perfect time for you to call in, 888-959-2743, or grab your smartphone, click on that QR code at the bottom corner of your screen. That'll take you right to the landing page for First Choice Financial Services Incorporated, and you can schedule your time accordingly. We know you have a lot of questions about retirement planning. This is your opportunity to have them answered. We'll be right back momentarily after this very short commercial break.
The work never seems to end until the day it finally does. After nearly a lifetime on the job, you should be rewarded for all the time you spent working. Whether that's crossing off items on your bucket list, learning a new passion, or rekindling the love of an old one. After all, life isn't over when you stop working. It's the start of an all-new chapter. The one where you're the writer and you get to choose how your story will go. A way to achieve that is by having a clear financial plan to sustain your golden years. The biggest fear most retirees have is if they'll have enough money to maintain the lifestyle they've always enjoyed. Having a plan to help protect you against the curveballs life often throws will help to maintain your lifestyle. Call today to get your free written financial plan so you may live every day to the fullest and enjoy the retirement of your dreams.
Welcome back to Midstate Money Talk. My name is Cynthia DeFazio, joined today by Kevin Dietrich and Joe Dietrich of First Choice Financial Services Incorporated. We're talking all about how to really properly plan for what the unknown tax rates could be in the future. And if you've been contributing to qualified accounts, you may want to make some decisions today. Gentlemen, this is such an amazingly informative show to our viewers at home. People I know are leaning in right now saying, oh my gosh, the Roth conversion sounds amazing, because we've talked about the importance of doing tax planning when the tax rates are low. But in case someone's wondering if a Roth conversion is a one-size-fits-all situation, Joe, are there sometimes I should ask you that a Roth conversion wouldn't be a good thing for someone?
Yeah, absolutely. Just the way we started this segment, there's no cookie cutter answer. To take a blanket statement and say you should do all of this or always do this is a mistake. So yeah, there are times where a Roth conversion doesn't fit in your plan, but it would be nice to know where that line lies. You know, if you are a significant earner now, maybe earning money that well exceeds your lifestyle needs, and maybe in retirement you're expecting a significant reduction in what you need to live on, that might be a situation where it doesn't make sense to defer those or pay those taxes now as opposed to later. You maybe have a very clear understanding you're going to be at a lower tax bracket. So you certainly don't want a blanket statement and say we're going to do a conversion there. You might have a pension, you and your wife or spouse may have a pension. That's going to increase your taxes in retirement as well. So you're going to start having different layers of income. So it's going to be very unique to every situation as to whether you should take a conversion or contribution to a Roth, and how much and what the timing is. So the timing of those withdrawals, the dates, the date of your retirement, are you going to retire early or late? There's a lot of factors that go into it.
Okay.
Absolutely.
All of these things need to be considered and properly planned out. It's so important. Well, obviously, Kevin, we started today's show. The question is to contribute or not to contribute. I feel kind of Shakespearean there, just a little bit. So what would be your advice to the viewers at home that are wondering, what do we do? What is the right answer to that question? Do we contribute or not to contribute?
Well, the right answer, obviously, is to pick up the phone, call us, and set an appointment with us so we can walk you through this.
Yes.
Because every situation is different. We cannot make a blanket statement to contribute or not to contribute to a qualified account, how much to put in the Roth, how much not to put in the Roth, when do you convert money from IRA, all that. All the thing we touched on today, can't just make a statement without knowing the facts. If you've working with an advisor, get a second opinion. Come in and speak with us. And we have that all the time. Folks says, they come to our workshop and they come into our appointment and I said, what brings you in today? That Roth conversion that you were talking about at the workshop, we want to know more about that.
Yeah.
So that really draws people because it's very important. I mean, it's, the number one of the biggest expenses in retirement is taxes.
Yes.
And so if you can try to eliminate some of those and strategically put your money in buckets where it needs to be, through planning, it's very important that we do that now.
And what we are choosing to save or not save in retirement, it's got to be towards the goal we have for retirement. So people that work with an advisor, 80% of people that work with an advisor are going to be on track for those savings in retirement, whereas a group that doesn't, almost half that are going to be on track for saving in retirement appropriately. So it's very important to have somebody you can sit down with and walk through and get a plan.
Absolutely.
We talk about IRAs or Roths or where should we contribute, depending upon your plan, your company may be matching some of your contributions. How do they match? How much do they match? We certainly don't want to give up the ability to have them matching some of those contributions. All of this has to fit together.
Yeah.
And that seems to be a common question.
A lot of times folks don't even know.
Yeah.
I say to them, how much is the company matching your 401k? I don't know. Here's how much I put in.
Yeah.
Or do they match a Roth? Well, I don't know. What's the Roth? Can I have a Roth in my 401k? Well, sometimes you can, depends on the employer.
Yes,
right?
you have to ask.
And so you have to communicate with your employer.
Do.
This is important stuff.
Absolutely.
It affects your retirement, affects your future. You should be up to speed on these things as a employee, and as a human being to make sure that you're getting your retirement as stress-free as possible, as much as you want out of it as possible.
Yep. Knowing the questions to ask and knowing where to put those answers to make sure they fit.
Absolutely. That's the most important pieces of the puzzle. I mean, Joe, we have only a little over a minute left of the show this week. Any final words of wisdom and guidance you would like to give our viewers at home before we say goodbye? Yeah,
I'm just going to reiterate that you need to pick up the phone, give us a call, scan the QR code, and come in and meet with us, because this is a very individual situation. There's no blanket statements. There's no blanket answers. Come in, sit down, we'll walk through your particular situation and put together a plan that's going to be right for you, a customized plan.
And Kevin, I'm going to give you the same opportunity as well.
Yeah, as I mentioned before, you have nothing to lose, everything to gain. Pick up the phone, click on the QR code, come in and see us. It's free. It doesn't cost you a thing to get advice and get some guidance.
Absolutely, gentlemen. Thank you so much for another amazing episode this week. To our viewers at home, most specifically, thank you for spending time with us today on Midstate Money Talk. We know that you have a lot of questions about how to plan your perfect retirement, questions about Social Security, questions about taxes, questions about your plan overall. For your customized retirement plan, don't miss the opportunity. Call in today, 888-959-2743, or grab your smartphone, click on that QR code at the bottom corner of your screen. You can schedule your time accordingly. Be safe, be happy, be blessed. We'll see you back 1 week from today. Take care.